Okay, hi everyone. This is going to be the second video for chapter 10. So I want to say we ended up here in the 40s. We're going to pick it up with decision making, right? So we've talked so far about like PP&E, other kind of like long-term assets. Where do we use these things, right? Or how might they come into play, right? With like PP&E. Well, one thing is capital budgeting, and you'll learn more about this in your sort of finance classes and things like that. But capital budgeting is something like this, right? Like in the future, we are planning, we're trying to make a decision. Do we want to buy this machine, right? Do we want to do that, this machine? We're going to compare, right, essentially all of the future cash flows from this machine, right? We're going to shrink it down in today and compare it with what that machine costs us, right? It's basically a decision analysis framework, capital budgeting to tell us if we should purchase the machine, right? So that's kind of the idea. I'll leave it more to your finance class to look at that. Also, right, when we're looking at PP&E, we got the fixed asset turnover ratio, right? It's a way to measure kind of the efficiency and the usage of our fixed assets, right? So it's going to be net sales over average fixed asset. Few kind of tricky things here, right? When they say average, that means beginning plus ending divided by 2. And when they say fixed assets, they mean net book value, right? Which is essentially going to equal generally your cost minus any accumulated depreciation on there. So here's an example, right? Okay, we're comparing the Gap with Ross Stores, their fixed asset turnover ratio, right? 5.4 with 6.26, right? So this guy over here is going to be the winner. Hey, they're better using, they're more efficient with their assets on that. An MCQ you can look at. Then they talk a little bit about exchanges, right? So the idea here is you're trading in an old asset and you're getting a new asset on there. So there's going to be, as a general rule, a gain or loss you have to recognize. We will see there's a few kind of iterations with this. But you can think of it almost like you're trading in a car. You give the old car, you get a new car. You might have to pay a little bit of a difference there on it. They got a 4-step process. Step 1, record the new asset at fair value. Step 2, remove the old asset. Step 3, deal with the cash. Step 4, you're going to plug any gain or loss. Right, so we have, a setup here. It looks like we're giving an old laser plus, 430 in cash. Right, that's what we're getting, that's what we're giving. What we're getting is a new laser. Right, so we have the 4 steps here, right? Step 1, I gotta kind of pull this up. Record the new equipment for 580. What's that? That's the fair value of the assets given, right? So that's basically the fair value of this is going to be 580, right? It makes sense. It says the fair value of 150 and 430 in cash, right? That gets you to 580. 2, we got to get the old laser off the books, right? So we're going to hit accumulated depreciation and equipment there. Step 3, we deal with the cash, right? We're giving them some cash as well, credit cash. Step 4, we're going to have a gain in this case. You're going to plug it. It could be a loss, right? If we look at the second example here, they change the fair value. It ends up being a loss. But kind of as a general rule, a 4-step process there when we make an exchange. there are some variations on this, right? So monetary asset exchange, one would be when the fair value is not determinable on this. A little bit rarer that this would actually happen, but we're having an exchange here. It says the fair value of both the new and the old equipment is not determinable. Essentially, as it says, right, it would be unusual for this to happen. It could potentially happen. We modify step one and we use the book value of the assets given to record the asset acquired. So for step one, right, we're going to use the book value of what we gave, right, which would in this case be the $430 in cash and the $100,000 there. Step two, right, get the old one off the books. Step three, deal with the cash. In this case, right, there's not going to be any gain or loss that would be recognized. In other words, when the fair value is not determinable, no gain or loss is recognized. Another kind of variation, right? The general rule is it will have these kind of exchanges commercial substance, right? That basically says whenever there's a change in the future cash flows, right? So hey, by getting this new machine, it can increase production, which would cause an increase in revenue or a decrease in operating costs associated with changes in future cash flows, right? So the general rule in these situations is that there is going to be commercial substance. By virtue of doing this, we're going to have a change in cash flows. There is the exception, right, for situations that lack commercial substance, right? So if we look at an example here, one that lacks commercial substance, essentially what we do here, right? So the old land had a book value of 2.5, get that off. We paid cash of 500,000. We can hit the new land basically as a plug on this, right? No gain is recognized in this situation. This is kind of showing this guy right here, the book value of the old, right? Book value of the old is now going to be the new on there. Summary chart you can look at there. Again, I'm more concerned with kind of that initial simple example, 1, 2, 3, 4, the steps on it. MCQ. Let's talk a little bit about self-constructed assets, right? This gets a little bit tricky because again, there's some variations and there's different considerations here. But hey, instead of buying a building, maybe we want to construct or make that building. We're obviously not going to have like a cost like directly in the sense that, hey, it's not like we have that pithy statement, bought building for $1 million. Instead, we're going to have to kind of track the cost separately on this thing. And really, there's kind of two critical issues. One is, how do we deal with the indirect manufacturing overhead? And then how do we, whenever we borrow funds, right, maybe we take a loan out to buy this building, how do we deal with that interest, right? Do we expense the interest or do we capitalize it as part of the building, right? So the manufacturing overhead, the indirect, you can see there's two approaches here on that. That's more of a cost accounting thing. So you can look at that in your cost and managerial accounting class. Let's focus a little bit more about the interest capitalization, right? What do you do with this? So if we look down here with the interest capitalization, it says to reiterate, the cost of the asset includes all costs necessary to get that ready for its intended use, right up until we flip the on switch. A self-constructed asset requires time to create it. During the construction period, the project has to be financed. This suggests the question as to whether interest costs during the construction period are one of costs of acquiring the asset itself or simply the costs of financing the asset, right? So on the one hand, we might point to the interest charged to finance inventories during their period of manufacture or to finance the purchase of plant assets from others. And we could argue that the construction period interest charges are merely costs of financing and should be expensed. So on the one point, you could argue like, hey, we need to expense these interest costs. On the other hand, you could argue that the self-constructed assets are different during the construction period. They're not yet ready for their intended use. And in keeping with this, we're going to capitalize it. So there's arguments for both ways, right? Do you capitalize? Do you expense these? With regard to the argument to capitalize it, right? You have to have the right type of asset, right? So assets that are constructed for the company's own use. One of the things here, only the interest we care about is only that interest incurred during the construction period is eligible for capitalization. Essentially, the period, right, is going to begin when the construction begins and the first expenditure is made. And then we're going to use in this framework the average accumulated expenditures, which is going to approximate the average debt necessary for the construction. We have an example here given some numbers, right? It looks like on January 1st of 2024, they began construction on a building. That's great. It was to be completed in June 30th of 25, right? So in year 24, we start right here. Here's the end of that year. It will be constructed and done by 6/30/25. Okay. A couple things here, right? It looks like on January 1st, we took out a $1 million loan, right? And that had an 8% interest rate on it. On top of that, right, our other loans, right, we had a note payable, right, we'll say note payable 1, note payable 2. These were for, what, 2 million and 4 million, and the interest rates on these were 6% and 12%, okay? Just some background information. Then they talk about expenditures for the project, right? So on January 1st, we had an expenditure. On March 1st, we had an expenditure. On September 30th, we had an expenditures, right? So we kind of had up until this point in time, 1.5 that we were into this thing. And then we have some expenditures in year 2 on there. Okay, so how we kind of unpack this, right? If we're talking about, hey, this loan, right? Let's kind of keep our eye on the prize here. This loan and our other debt, right? This is the construction period, right? We have some interest here. Do we capitalize this? They're giving us a 3-step process. Step 1, determine the weighted average accumulated expenditures. Step 2, calculate the amount of interest to be capitalized. Step 3, compare the calculated interest with the actual interest. Okay, we got step 1, right? We got to determine the weighted average accumulated expenditures. 2 kind of setups here. One is if the expenditures are incurred evenly throughout the period, you just take the 1.5 and divide it by 2, 750. If they are not incurred evenly, which is the case here, right? If we go back, right, what slide are we on? Right, this isn't like even Steven, these exits, right? January, March, September, we're just kind of going through and doing these, right? In this case, when they're not incurred evenly, we have to kind of figure out the weighted average, and it's going to be based on, right? So one of our expenses was January 1st, right? So we got to tee up 12 months for that. One of them was March 31st, right? So we got to tee up 9 months for that. Then we have September, right? Which we're going to have 3 months for that, right? Until we get to the calendar year end there, right? So 12, 9, 3. Essentially what we do here, right, to get the time weighted, right, in light of the time, you do 500, times that, 400 times that, 600 times that, work to the right, and then sum it here, right? So 950,000, that's step 1 on there. Step 2 is we have to calculate the amount of interest to be capitalized. So we're going to take the 950, step 1, and multiply it times the 8%, which is essentially, right, the loan, right, that $1 million loan. They're telling us there was an 8% rate on that. right? So that gets us 76,000. Step 3 is we have to compare the calculated interest, step 2, with the actual interest, right? So we're going to look at that kind of construction loan, the note payable 1, note payable 2, and just kind of run those through there. Pick the lower of the two, right? 76 is less than 680. What does this all kind of mean here, right? Well, essentially in this case, at the end of year 1, right, the building, what are we going to have it on our balance sheet, right? The sort of accumulated costs here is going to be the 1.5 actual expenses with the 76 of interest that we calculate on there, right? So you can kind of look at that with more specific information on there, right? So that was like year 1 analysis. You would do the same thing in year 2. And essentially, right, if we were to look at it in this framework when we're talking about capitalizing interest, they really give you two different sort of methods here. One is the specific interest method. What we just did, right? Step 1, step 2, step 3. And then we have something called the weighted average method, another way we can look at this, right? So it says down here, sometimes it's difficult to associate specific borrowing with projects. In these situations, we would use a weighted average rate on all interest-bearing debt, including all construction loans. So what we do here is, right, we look at all our debt under the weighted average method, right, figure out the interest on it, foot that, right, and then essentially take what we calculated, the 680, divided by the amount we have outstanding. That gets us 9.7%. It says then you would simply multiply this rate, the 9.7%, times the average accumulated expenditures. That will tell you how much interest you capitalize. Okay, different little framework there. Here's a footnote, right, kind of showing how this might materialize in the financial statements. In MCQ, you can look at. Let's talk a little bit about research and development, right? So I'm going to try to draw the fence there in the sense they are separate things, right? So like even though it's always called R&D, they technically mean different things, right? So research is the planned search or critical investigation to discover new knowledge, whereas development is translation of research findings into a plan or design for a new product or process. So separately, two separate things, even though we always call it R&D. Remember, there is the and there, the Amsterdam, suggesting they're two different things. Okay, how do we deal with this? Well, the general rule with R&D is you're going to expense it, right? Expense, expense, expense. And what would be some examples on this? So I don't know, maybe we have a story, right? Maybe we are working at Pfizer and we're trying to figure out the vaccine for COVID 2.0, right? It's now like Omicron, super COVID, right? Whatever new variant they have. At least they stop with those variants on it. Right? We're trying to figure out this vaccine. So we, in order to do this, right, maybe we hire some research scientists, right? We got to pay them some wages. We buy, a building. We do this, right? All of these costs, right? It's our research and development to help find this vaccine, right? The general rule is if we're using this just for a single project, right, like just COVID 2.0, you're going to expense these costs. If, however, right, the asset that we purchase is going to be used in more than one research project, right? Maybe we're using it in COVID 2.0, right? We buy a building, right? I don't know, or equipment or a facility, right? We buy a facility. We're going to use that in COVID 2.0. And I don't know, we're going to use that to try to figure out a cure for cancer or something, right? Just some other sort of thing there. So we're using it for these things. In that case, right, when the asset purchased the facility, a building, right, where we're going to do this research, is you're going to depreciate or amortize that, and that will become part of R&D only in the period the assets are used for the R&D activity. So we'll come back to this. We'll see it in an example on there. With regard to research and development, right, we said the general rule is going to be expense, right? So that's kind of this guy right here. Once you hit commercial production, technically that's not R&D costs anymore, right? So I don't know, maybe we make the vaccine, right? We start producing it, right? We do these other things, right? We start to refine it, enrich it, right? We adapt it. That's not R&D, right? We have the product, the vaccine is made. These items over here, you probably will expense, but just not as R&D. You could capitalize them depending on, what they are. But general rule, just for naming purposes, if it happens before we hit commercial production, it's R&D. General rule, you're going to expense it. If it happens after commercial production, probably you will expense it, but it's not definitionally R&D. Okay. Let's look at an example here to kind of flesh this out, right? We have a company, they're trying to develop a new industrial plastic, right? That's kind of the goal. Just like we were trying to make that vaccine for COVID, hey, here they're trying to make a new industrial plastic. We have some costs here, right, with it. So it says on top of this, right, the project, it ends up, they get a patent on it. That's great. And they also purchase some equipment that they're going to use on other projects, right? So that's kind of like whenever we talked about, COVID 2.0, and then they're going to use it for cancer research as well, right? So that's, it's going to shake some things up here. So the patent and the equipment we'll deal with separately. The first question becomes, hey, of all these expenses, 1, 2, 3, 4, 5, what is right off the bat R&D, right? So the salaries, the supplies, and the payment for services performed, right? That's journal entry 1. Here we go. Debit R&D expense, 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 credit cash, okay? How about, right, so we dealt with these. How about this guy, right? The equipment, the 500,000. Well, with this, right, we're using this for 2 projects, right? Kind of project 1 in project 2, right? Like COVID and cancer, whatever the new thing that's kind of ruining the world, right? Well, the first thing is we got to put it on the balance sheet, right? Debit equipment, credit cash. There we go. It's on the balance sheet. And because, right, it's used for multiple products, right? It's kind of product 1 and product 2, or whatever, the 2 things are. To the extent we buy that equipment, right? So I don't know, put a house or put like a machine or something. With that, when we start to, right, so we put it on the balance sheet, and then when we depreciate it, right, even though we're depreciating it, that's when we're going to call it R&D expense in that period, right? So debit R&D expense, credit accumulated depreciation. So that's what this guy says here. If we go back to it, right, an asset purchase for more than a single project, depreciation or amortization is going to be R&D expense, which we just saw, but only in the period the assets are used for the R&D activities, right? So that was this guy right here, depreciation expense, but only in the period it was used in the activities. Finally here, right, so we dealt with all of those. We dealt with that. We have the patent, right? So the idea with the patent is generally all of those costs, right, the R&D cost to get the patent, we expensed. That's great. The patent itself, we had some costs with it. In other words, hey, we had to pay like the US Patent Office a fee. We had to hire an attorney for this patent. So that's going to be capitalized right on there as a patent, right? Debit, patent, credit, cash. So to kind of tie this back into the first lecture, right? Remember I said like the general rule was up until you capitalize and up until you flip the on switch. With a patent and a lot of these intangibles, you're going to capitalize purchase price, legal, that's what we're doing here, 100 grand, but not internal R&D, right? This we kind of expensed as a general rule. Okay, you can look at that slide. Don't worry about IFRS stuff for the exam. A few kind of other sort of twists and turns here. We have to talk a little bit about computer software. So this is kind of a variation of R&D expense, and it gets more complicated if you're developing this for like internal use versus you're developing to sell it. But the big thing we care about here, right, is hey, maybe we want to make some computer software. Maybe this is like, I don't know, Microsoft Word 4.0 or something, right? It's some type of software we're going to use. We have this idea for a new software, right? So what happens here is we have this idea, we're going to expense that research and development to create this like Word 4.0 until we hit technological feasibility. You can kind of think of this like, it's almost like a working model, right? So expense, all planning, designing, coding, and testing, right? You expense all of that. Then when you get that working model, right, then you kind of, if you throw more money into this, right, you have additional kind of refining, so it says down here, um, blah, blah, blah. Costs incurred after technological feasibility, but before it's available, are capitalized as an intangible asset. So any further coding and testing, right? So these are going to be capitalized, any kind of additional costs, right? We're going to put an intangible asset on the balance sheet for it. And you do that, you continue to do that until the product release date, right? Then the product is out there, right? That's great. Once it's out there, right? If you have costs after that, well, that's not R&D, right? You only have R&D until you hit technological feasibility. Any cost after that, you're still going to expense as a general rule, maybe as like a selling expense or administrative expense, but they're not R&D. Okay, the big things here for computer software is technological feasibility. That is like a line of demarcation, expense capitalized. And then, whenever you release the product, that's like a second line of demarcation on it. Cloud computing, you can read that, look at it. How about, right, another kind of spin on all of this is whenever we have R&D performed for others, right? So say that, when we were looking at that R&D with, creating like the COVID 2.0, that assumes that we work for like Pfizer, right? Say, however, right, we have Pfizer, right, and they just hire us, company X, to do the R&D for them. So in other words, we're doing the R&D, but not for our own company, right? We are performing it for somebody else, Pfizer. In this case, right, this situation, right, the first thing we looked at was when we actually work for Pfizer, right? There's us, we work for Pfizer. We're going to generally expense when we do the R&D. But if we're some third-party company that they hire us, right, we're going to capitalize that R&D as inventory. So a little bit of a different treatment there on it. You can look at this guy right here for purchased R&D, right? Any R&D costs after the acquisition are expensed as incurred. And then let's talk a little bit about startup costs, right? The idea with these is that they're going to be expensed. So hey, you're forming a new business, right? You have to hire attorneys. You got to pay a filing fee to the state, right? You got to pay accountants. All of those things, those kind of startup costs, are going to be expensed in the period incurred. In other words, you don't capitalize them. Finally, here a little bit with like oil and gas accounting, right? So we're talking about oil and gas exploration costs, right? So if we go back up here, let's see, is that in here? So exploration costs, and I think, right, here we go. Exploration costs are expenditures such as drilling a well or excavating a mine or any other cost searching for the natural resource, right? So we're exploring, we're trying to find the gold, the copper, right? Whatever is there on it. In this way, right, we have two methods to account for those exploration costs, right? We have method one, which is the successful efforts method, and method two, which is the full cost method, right? Some of this we're going to expense, some of this we're going to capitalize depending on the method we use, right? So, hey, maybe we throw some money into this. We have, a gold mine. We're looking for gold, right? Any exploration costs known not to have resulted in the discovery of oil or gas, right? So it's kind of like a sad face, right? We spent this money, we didn't find any gold, right? We're not going to be happy with that. You expense those on it. Anything that would be a smiley face, right? You did find gold, you would capitalize on there. In distinction, the full cost method says, hey, any money you put in to it, regardless of whether it's the outcome on it, you're going to just capitalize it. Okay, so let's look at an example here. We have an oil company. They spent $2 million for on each 10 times, right, to look for oil. Okay, 8 of the 10 holes they drilled were dry holes, right? So that's sad face. They didn't get any oil or gas in there. So what they said here is under the successful efforts method, right? The sad face, right? We didn't find any, oil or gas or gold. We're going to expense. However, the happy face, right, where at least 2 of the 10, right, we did get some gold or we got the oil and gas. We'll capitalize. So hey, we spent 20 million, right? Always start with cash. 10 times 2 million on both of them. Under the successful efforts method, right, you got the frowny and the sad face. What do you expense? What do you capitalize? Under the full cost method, right, both of them, you're going to just capitalize. Okay? So with that, we'll finish the lecture here, right? We'll have some problems to look at it and kind of build this out further.